Welcome to This Explainer. Today, we are diving deep and dissecting the absolute bedrock of wealth creation. Look, whether you're a seasoned veteran of the markets or you're just actively starting to scale up your portfolio, true financial momentum really boils down to mastering two distinct but totally interconnected levers: your investment strategy and your debt architecture. Mastering these forces, that's exactly what separates the people who build lasting, compounding wealth from those who just stay stuck in a cycle of inefficiency.
So here's our roadmap for today. We'll kick things off with the financial crossroads, then look at active versus passive investing and ask which wins long-term. After that, we'll dive into good debt versus bad debt and wrap it all up with the difference changing everything. All right, part one, the financial crossroads.
Moving right along to part two, active versus passive investing.
So you already know the deal with active investing. It relies entirely on the premise of alpha. It's all about generating those excess returns above the market benchmark, right? But to do that, it demands intense fundamental analysis and rigorous market timing. Plus, you're absorbing much higher management fees and transaction costs. And honestly, the psychological toll of that daily volatility and constantly having to recalibrate your positions, that's basically the hidden tax active investors willingly pay while they're out there chasing outperformance.
Now, passive investing operates on the exact opposite end of the spectrum. Instead of fighting the market, it just leverages the overall upward drift by tracking broad indexes. By totally neutralizing the need for constant trading, it strips away all that management friction and really minimizes your capital gains taxes. You're basically relying on decades of macroeconomic growth instead of trying to hit home runs with quarterly stock picking.
When you compare them side by side, the contrast is purely structural. Active management means high fees, high effort, and elevated stress, and it's all for the elusive promise of beating the market. Passive management, on the other hand, sacrifices that chance of massive outperformance, but in exchange, you get low fees, minimal friction, and you capture consistent baseline market returns over long durations.
Which naturally brings us to part three, which wins long term?
It's the ultimate question, isn't it? If we zoom out over a 20 or 30-year horizon, which methodology is actually going to preserve and multiply your capital more effectively?
Well, when you stretch compounding across decades, friction literally becomes the ultimate enemy of wealth. I mean, the sheer mathematical difficulty of consistently picking winners, combined with the structural drag of high management fees, it acts as a severe anchor on those active returns. Historically speaking, the low-cost, low-friction framework of passive investing allows the market itself to do the heavy lifting. It just lets compound interest run uninterrupted for the vast majority of participants. It's like letting a snowball roll down a massive hill without putting any roadblocks in its way.
All right, let's pivot a bit. Part four, good debt versus bad debt. Okay, so good debt is essentially a tool for positive leverage. You are strategically acquiring capital at a fixed cost, specifically to purchase assets whose yield or appreciation outpaces that original cost of borrowing. Whether you're talking about a cash-flowing rental property or raising capital to build a scalable business, the debt serves as an instrument to actually accelerate your return on invested capital and massively expand your balance sheet.
Bad debt, though? That acts as a severe financial headwind. We are talking about capital borrowed at incredibly high and typically non-deductible interest rates to buy depreciating consumer goods. Because the value of the underlying asset drops while the compounding interest mounts up, this type of leverage actively erodes your net worth from the inside out. It's a wealth killer, plain and simple.
Ultimately, your financial health is a massive balancing act of leverage. Accruing strategic, cash-flowing debt that tips the scales toward long-term wealth, but servicing high-interest consumer debt tips it heavily towards systemic drag. The structure and the productive purpose of the liability matters exponentially more than just the principal amount alone.
And that leads us to our final section, part 5, the difference changing everything.
Here's the absolute core thesis of our source material today. The meticulous categorization of your debt paired with crystal clarity on your investment time horizon completely alters your financial trajectory. It's a total game changer. It is the defining threshold between perpetually laboring for a paycheck and actually engineering an automated system where your capital does the heavy lifting for you.
So let's synthesize this. Strategy absolutely eclipses raw income. Think about it. High earners with terrible capital allocation stay poor, while modest earners with optimal strategies build fortunes over time. You have to know your investing style, embrace the long game to minimize friction, and just be ruthless about separating productive leverage from destructive debt. Which brings us to a final, critical evaluation of your own portfolio. Honestly ask yourself, are you aggressively utilizing positive leverage and low-friction investments to build an absolute financial fortress? Or is your wealth silently leaking out through high fees and destructive liabilities? The path forward requires ruthless honesty with your own balance sheet. Thanks so much for joining me for this explainer, and we will definitely see you in the next one.